In the previous two readings inside of this study session, the learning outcome statement words typically were describe and compare. And we're going to have a couple of those inside of this reading, but the important one is to calculate. So let's get right to the slide deck. This first one, calculate a bond's price. This is what you guys should remember from previous readings, that the price of any financial security, whether it's a bond or a share of stock or a swap contract or an option, is the present value of the expected cash flows from that particular security. So in this case, we're trying to price a bond. What do the bondholders get out of owning a bond? Well, they get an explicit promise from the issuer, whether it's a corporation or a government. They get an explicit promise that sounds something like this. I, the borrower, promise to pay you regular interest payments. And by the way, we're going to call those coupon payments inside of a bond. I promise to pay regular coupons to you, plus I promise to pay you a principal or a maturity amount at the end of the life of the bond. And so the price of a bond, the price of any bond, is going to be the present value of that explicit promise. The present value of the interest payments plus the present value of the principal payment. Now the reading talks about an option-free bond, and that's important. An option-free bond is one that does not have an embedded option inside of the prospectus. In other words, that the explicit promise of interest and principal is explicit. There are no contingencies. And we'll talk at length about bonds that have embedded options during some other reading, and particularly in level 2. So notice what the bullet points describe. Present value of the future cash flows discounted at a market discount rate. So we need some estimate of that market discount rate. We're going to call that the yield to maturity on the bond. I want you to think of the yield to maturity on the bond in the following way. Of course, it's the market rate of interest. It's the current borrowing rate that the borrower has to pay. It's oftentimes known as the required return on the bond, but mathematically, it's also an internal rate of return. So all those mathematical principles that we talked about in one of those early readings apply to the yield to maturity on the bond. Let's take a look at a quick example. Suppose we have a 5-year bond with an annual coupon rate of 5%. All right, so that coupon rate, that's the stated amount of interest on the bond. In order to get the coupon payment, what we're going to do is take that 5% and multiply it by the par value of the bond. And to save space, the convention is just to use $100 in par value. So we take 5% of that $100. So the explicit promise is, I promise, as the borrower, to pay you $5 on every $100 bond that you own every year for the next 5 years. And then at maturity, when the bond matures, I will pay you that $100 back. So look at the timeline there. In year 1 and 2 and 3 and 4 and 5, you have that $5 coupon payment. And then at the end of year 5, you have to add in that principal payment as well. Now, if the yield to maturity or the required rate of return on the bond is 6%, we have to discount those future cash flows at that relevant and appropriate market discount rate. And so what I've done for you under the timeline is show you the long way to do it. So really all we're going to do is take 1 plus the yield to maturity. Remember, we called that the time value factor. And we're going to raise it to the 1 and the 2 and the 3 and the 4 and the 5 all the way out to the end of the bond. And we'll compute those individual present values and then sum them to get 95.79. But of course, you're not going to take all of this time to discount each of those future cash flows. You're going to get out the financial calculator. And whether you have the BA2 Plus or the 12C, what you're going to do is enter it just like this. So 5 is N, 6 is the interest rate, 5 is the PMT. Remember, there is no ANN button on the financial calculator, which would be the annuity, because look, that $5, that's a regular old ordinary annuity. There is no ANN button, but it is the PMT button, could be the ANN button. And then 100 is future value. Now remember, you guys who have the BA2 Plus, you have to hit the compute present value Those of you who have the 12C, just hit the present value button and you'll get that same 95.79. And so clearly, I mean, do we want to have a race? How about half of you guys do it this way, the other half do it this way, and I promise you the half that are using the financial calculator get it decades before. All right, so you're not going to do it that way, but this, of course, is really a great explanation into determining exactly the mathematics and the interpretation of bond pricing. So this is a good slide to look at and kind of absorb, but of course, pragmatically and practically, you're going to use the financial calculator. Now, here are a couple bullet points on this yield to maturity that I've been telling you about. There's a good one there. It is the internal rate of return of the bond. It is the uniform interest rate in which we compute that present value, and that's going to be the price of the bond. And then in a formula form, what we're going to do is put it there in the denominator. And so notice I have the yield to maturity divided by 2. And that's because the convention is, I mean, almost all bonds pay interest semi-annually. How about the next LOS? Identify the relationship among bonds price, coupon rate, maturity, and the yield to maturity. All right, so here's the starting point. What do corporations and businesses try to do when they issue a bond? Well, what they try to do is match the coupon rate with the yield to maturity on the bond. And if those two things match, then the bond can be issued at par value, like $100 or $1,000. And that's the goal. But remember that it doesn't happen like this. Governments and businesses, they have to register with the SEC, so there's a time lag. And so the bond price, when it is issued, is probably not going to be exactly at par value. But remember, the borrowers try to set that coupon rate so that the bond price does trade initially at par value, but that hardly ever happens. All right, so then what do we know? The coupon rate is fixed. This is a fixed rate bond, so the coupon rate is fixed. Like, for example, we had that $5, right? It was 5 in year 1, 5 in year 2, 5 in year 3. So that is fixed. But remember how I defined the yield to maturity on the bond. It is the required return on the bond, but it is also the current borrowing rate for the bond holder, right? So what that means is that the yield to maturity is going to rise and it's going to fall with changes in the macroeconomic environment and changes to that specific issuer. All right, so if the yield to maturity rises above the coupon rate, then the bond will sell at a discount. If the yield to maturity falls below the coupon rate, then the bond will sell at a premium. And so there's a good little seesaw at the bottom. When the discount rate, look on the bottom right there, when the discount rate or the yield to maturity goes up, bond price has to fall. So there's an inverse relationship between prices and yields. Now, a couple of other points to make here to complete that LOS. There's something called the convexity effect, meaning that percentage changes in bond prices are not symmetric. In other words, when the market discount rate goes down, the percentage change in the bond is greater than when the market discount rate goes up. That's called the convexity effect, and that's going to be super important in level 2. The coupon effect simply tells us that for bonds that have lower coupon rates, those bonds will experience greater price changes when that market discount rate changes than when higher coupon bonds experience those changes. That's the coupon effect, and that should make some sense. I mean, if you go back and instead of $5 on our timeline, put in $15 on our timeline, for every 1% increase in the yield, then the lower coupon bond price is going to fall by a greater amount. And then the maturity effect, this is going to be extremely important going to level 2 and also to level 3, is that longer term bonds have what is known as greater interest rate risk, which means that when the yield to maturity goes up, longer term bonds experience a greater fall in price. And we're going to measure that by something called the duration of the bond, but that's called the maturity effect. So I would know those definitions: convexity, coupon, and maturity effects. Define spot rates. Spot rates are an interesting kind of financial market data phenomenon. Spot rates are the rates that answer the following question. Let's suppose that there were lots and lots of zero coupon bonds available at maturities of 1 year and 2 year and 3 and 4 and 5, all the way out. All right, zero coupon bond, which simply means that there are no coupon payments over the life of the bond. So all the bondholder gets is that $1,000 at maturity. Well, spot rates are the yield to maturity on those zero coupon bonds. They're also called zero rates. All right, so there's a good definition. That's the first part of the LOS. But how about calculate the price of a bond using spot rates? All right, before I do this, what I want to do is swing back. I want to swing back to this dude right here. And so I want you to think about this. Look at that timeline there. We know that the coupon payment is fixed. That's $5 all the way out. And that $100 maturity value is also fixed out there, right? But notice what we're assuming. We're assuming that if we pay $95.79 for that bond, we're assuming that the yield to maturity on that bond is 6% and it's going to stay 6% for 5 years. So that is a limiting or a constrictive assumption. Spot rates take care of that. What do spot rates say? Spot rates say, wait a minute, let's discount those future cash flows at the appropriate discount rate that applies to that time period. So we're going to use those zero rates. We're going to use those spot rates to help us calculate the price of a bond. All right, so let's do this one here quickly. We have a 3-year bond that pays a 6% annual coupon. So you should automatically think, all right, Jim, I know what this means. That's $6. Then $6, then $6 each in year 1, 2, and 3, then the $100 maturity payment at the end of year 3. And now I'm going to discount those to get the price. Of course, price of any bond is the present value of those expected cash flows. But now, instead of, like we did before, compute the present value at a constant yield to maturity, we're going to calculate that bond price using those spot rates or the zero rates. So they're given to us in the problem as 3%, 4%, and 5%. And so we do the time value factor in the denominator, 1.03 raised to the first power, 1.04 raised to the second power, and 1.05 raised to the third power. We sum those and get a price of 102.95. Isn't that a thing of beauty? Now, I'm guessing that you guys are thinking, okay, on the next slide, Jim is going to show me a shortcut, much like he did using that financial calculator. Well, the bad news is there is no shortcut. So you have to get on your working gloves, get out your shovel, and dig away. There is no shortcut to this one. How about comparing bonds that are being priced on the interest payment date versus those bonds that are being priced in between interest payment dates? All right, so we need to bring in some terminology. We need to worry about the flat price of a bond or the full price of the bond. So look at the timeline there. February 1st is the last coupon, and then August 1st is the next coupon. But if you want to buy or sell that bond on June 1st, notice that there's going to be some accrued interest that the bondholder is earning, at least implicitly earning, from February 1st all the way to June 1st. Now remember, you get the payment on February 1st and you don't get the next payment until August 1st. So clearly, if you're the bondholder, you're going to say to yourself, oh, I should be getting this interest. If the bond paid interest, let's say daily, I would have gotten all that interest. But of course, no bond issuer is going to pay interest daily or even weekly. Some could do it monthly, but it's mostly biannual. All right, so let's define these two prices. So the flat or clean price is the price that does not include any accrued interest, but the full or dirty price includes the interest accrued since the last coupon payment. And there's a good formula right in the middle there. Accrued interest is simply the payment, the coupon payment, and it's adjusted for time. And so small t is the time period from the previous payment up until today's date, and then big T is then the entire period. So really, that lowercase t divided by the uppercase T is really just a fraction of that time period. Now, you can accrue interest two ways. You can do it like lots and lots of people with the, hey, you know what? It's too complex to have 365 days a year. And so let's just suppose that every month has 30 days and every year has 360 days. Or you could do the actual number of days during the course of the year, including weekends and holidays, and on those odd every 4 years where we have February 29th. Here's a good LOS. Describe matrix pricing. All right, so what do we talk about in those two previous readings, and then in some of the other readings back in economics and in corporate finance? We talked about bond issues, and we said something like, corporations and governments, they like to issue bonds. They like to have their money pretty quickly. Well, remember what I said to you, that the liquidity that's provided by the primary and the secondary markets really supports all of this lending of capital. And the primary market wouldn't exist without the secondary market. But here's the practical implications of all that. Not all bonds are actively traded. In other words, not all bonds trade thousands of bonds every day. So what happens if you're trying to price a bond that's not actively traded, or a bond that never trades? Well, of course, this is how we solve lots and lots of problems in business, but of course we solve lots of problems in the financial services industry by just looking around and saying, okay, here are the characteristics of my bond. Let me find a bond that looks an awful lot like my bonds. And so we're going to look at some comparable bonds. All right, and so let's just take a quick example. Let's suppose that we're trying to compute the price of a 4-year, 5% annual coupon payment bond, bond K, which is not actively traded. So let's find bond L, let's find bond M, one of which is a 3-year bond, one of which is a 5-year bond. So notice our bond is a 4-year bond that conveniently falls right in between. And so those yields to maturity on those bond L and bond M are given in the little timeline I have there. So all we're going to do is take an average. So yield to maturity is 3.4 on the shorter term bond, and it's 3.4 on the longer term bond, and 2.69 on the shorter term bond. So you take an average of those two. So we're going to price our bond using an average of those two bonds. One is shorter, one is longer, but they have similar characteristics as our bond. Maybe they have the same credit rating. And then we'll price that bond. And so what did we say? Our bond was a 4-year bond. There's the $5 in interest in the numerator. There's the $100 in principal in the numerator all the way out at year 4. And we're going to discount those at the 3.045%, sum those and get 107.62. And the good news is there you can do a quick calculation with the financial calculator. So we make payment as 5, we make future value 100, the yield is 3.045, and is 4, solve for present value. And just by way of memory here, I always write that payment equals 5, but remember, you got to hit the 5 first, 5 then payment, and so on. All right, next LOS asks us to calculate and interpret a whole bunch of different returns: bank discount yield, holding period yield, effective annual yield, money market yield for treasury bills, and other money market securities. All right, so let's identify these money market securities. So these are financial securities, financial instruments that mature in less than a year, like treasury bills, commercial paper, municipal notes, or bankers' acceptances. And so what do we know about these money market securities is that they almost always, they don't have to, but they almost always sell at a discount. And so there are a couple of different ways to measure kinds of the return on investing in these money market securities. So let's go through several of these. We'll do, I think there are 4 of them. Yep. So let's go back to bank discount yield. And so this is used to calculate the yield on treasury bills, quoted purely on a discount basis. So there's that discount again. So we take the face value minus the price, which is going to be less than the face value. So the face value of a treasury bill, let's say it's $10,000. So the price is going to be, $9,940 or something close to that. And then we adjust it for time. The holding period yield is exactly like we just did back in the holding period return. The holding period return, and it has the same formula there. And so holding period yield is now what the term is when we're relating it to money market securities. The effective annual yield, and I warned you about this before, if the holding period return, or in this case, the holding period yield, is less than a year, we have to annualize it. So that's what the effective annual yield is. And so notice that we use a 365-day year for the effective annual yield. And then the money market yield swings us back to a 360-day yield. That's a convention that goes back hundreds of years, maybe not hundreds of years, but a long, long time, before they had computers, just to make life simple. It's really hard to divide by 365, so you could easier divide by 360. And there's the money market yield given a bank discount yield. All right, so let's go ahead and talk just a little bit more about these. If you're given one of these, you can easily find the others by considering the point that the holding period yield represents an actual return on a money market instrument, but here's the big assumption that it's held until maturity. And when we annualize the holding period return on, the holding period yield on the basis of a 365-day year and carry out the compounding, the result is the equivalent annual yield. And then the money market yield is the annualized version with 360 days. And so let's go ahead and do a problem here. Suppose we have a T-bill selling at $990, matures for 1,030 days. Let's compute all of those things there. So there are the formulas, and there are the inputs given. We have a $1,000 face value. We've got a price of $990. We have 30 days. So we're just going to input those into each of those formulas, and we're going to get 12% and 1.01%. That's 30 days, remember. And then we're going to annualize that in the effective annual yield. So we compound that out using the 365. That gets us to 13%. And then if we annualize it using the money market yield, we use just the 360 days, and we just multiply by 12. In this case, 360 over 300, and that gets us 12.12%. So I'll allow you to pause the video to get caught up in the mathematics of that page. A bond equivalent yield refers to the annualized periodic yield calculated by multiplying the periodic yield by the number of payments in a year. And, kind of the convention here is that since bonds pay interest semi-annually, that's why this is called the bond equivalent yield. And so the yields are quoted as twice the semi-annual rate. Let's go ahead and do a quick example here. We have a 3-month loan, holding period 4%. What is the bond equivalent yield? So first we convert that to an effective semi-annual yield. So we add 1 to the 4%, 1.04 squared. So we're squaring it to get from 3 months to 6 months. Subtract 1, that gets us up to 8.16. And then we multiply it by 2 to convert that semi-annual yield into the bond equivalent yield of 16.32%. How about some definitions here? Effective annual rate has a periodicity of 1, as there is only one compounding period. Periodicity is the number of periods in a year. So with the bonds, if we're paying these semi-annually, which is almost always the case, then that periodicity is the number of periods in a year, which will be 2. Street convention assumes that payments are made on the scheduled dates, probably not on weekends, probably not on holidays. But the true yield is calculated using a calendar that includes the weekends and holidays because, after all, there are risky events that can occur on weekends and holidays that will affect the bond price when trading opens on a Monday or after a holiday. Current yield is kind of like the dividend yield on a share of stock. Just take the coupon payment over the price of the bond. And then the yield to worst is kind of like the yield to maturity. Yield to maturity is the yield to maturity is the rate of return that you will earn as the bondholder if you hold the bond all the way until it matures. The yield to worst is kind of an interesting concept. It's same thing as yield to maturity, but it asks the questions: what happens if a major event occurs? So the yield to worst is the lowest potential yield that can be received without the issuer defaulting. How about yield curves? All right, so let's go ahead and let me give you just a definition of a yield curve, which we did back in the economics days. Yield curve is just a picture, an illustration where we have maturity dates along the horizontal axis and the yield to maturity going up the vertical axis. And so the yield curve is really a picture, an illustration of the relationship between yield to maturity and time to maturity. But there are different kinds. There are different kinds of yield curves. All right, so the spot curve is the yield on zero coupon government bonds. This is what we just talked about a few slides ago with that spot rate. The par curve this is interesting because the par curve is going to be the yields as if each bond were priced at its par value of $100. See, in order to get the par yield to maturity, you have to do some adjustments. And then a forward curve is a series of forward rates that each have the same time frame. So let's suppose we're interested in borrowing money for 1 year from today. So that forward rate would be all the way 1 year, the 1 year expected rate 1 year from today. And you can draw those forward curves over almost any timeline, over all of those maturities. All right, so what did I draw there? I have an upward sloping yield curve. And we'll talk at length about the slope and the meaning of those. It'll be a big deal in level 2. Define forward rates and spot rates. All right, so the spot rate is just the rate on a loan that begins immediately, right? And the forward rate is the interest rate on a loan beginning sometime in the future. And so this is a really interesting concept because lots of times businesses and organizations and governments, they know what they need to borrow today. So like our Treasury Department, it goes out and borrows money a couple of times a week, and it knows that it needs money today to fund the government. But lots of times borrowers know that they're going to need to borrow it sometime in the future. And so a business might say, you know what, a year from now, I'm pretty sure I'm going to have a positive net present value project, and I'm going to need $10 million a year from now. Well, one of the choices is to say, all right, I'll just borrow the $10 million today and then invest it somewhere. Maybe in a treasury bond or something like that. But then the borrower is probably going to be paying a higher interest rate than what they're going to be able to earn in the treasury market. And so there's the lost time value of money in there. So what businesses like to do is they like to estimate that forward rate, and that gives them a really good decision point of whether to borrow today or to wait. I mean, clearly, if you knew that if you could borrow today at 5% and you knew with certainty that interest rates were going to be, let's just say some crazy number, 25% a year from now, well, then, of course, you would borrow as much money as you possibly could today at the lower rate so that you didn't have to pay that higher rate. So forward rates are really important for capital budgeting for businesses so that they can plan on their capital structure. All right, so there's a good formula at the bottom of the page that describes the relationship between the two spot rates and the implied forward rate. So look on the left side there. So we have a rate over some time period, say 1 year, and then look over on the right side, we have some time period over there, let's say that's 4 years, and then in between, we want to know what that implied forward rate is going to be. All right, so let's go ahead and do a quick example. Let's suppose that we've got these yields on a 3-year and a 4-year zero coupon bond, 3.5% and 4% semi-annual basis. What we want to know is what happens, what is that forward rate, 3 years from today on a 1-year loan. So if you look at this thing, you can say, all right, I can borrow for 3 years at 3.5%, or I can borrow for 4 years at 4%. But what I'm interested in is I want to know that if I fast forward 3 years from today, what is going to be that 1-year rate? And we're going to use, let me swing back here. We're just going to use that formula at the bottom to do this. And so here are the steps. And I will let you guys pause. This is just some good simple algebra. I'll let you pause to make sure you can get that 5.5%. And so all we're saying is that we expect interest rates to rise. How about yield spread? This is an important concept, especially when it comes to evaluating two different kinds of bonds, whether those two different kinds of bonds are different in any kind of a capacity, whether it's coupon or rating or duration or convexity. What we want to know is what the difference between the two yields is. All right, so a yield spread is the difference between any two bond issues. And so it's really just a simple subtraction that we all learned back in kindergarten. So we take the yield on the first bond and subtract the yield on the second bond, and that's going to be the yield spread. The yield spread is almost always reported in basis points. And when the second bond is a benchmark bond, then the yield spread is sometimes referred to as the absolute yield spread. And this is important for corporations to know. If the government is borrowing at 5% and the corporation is borrowing at 8% over the same time period, let's say, well, then those are 300 basis points. That's going to reflect the credit rating or the credit quality of that particular bond. Now, what causes the spread? And so in the top box, I have the spread, and that's just this one here, the difference between two bonds. And so that's just going to be the risk premium. That was that 300 basis points that I described earlier. For the benchmark, the difference between those two is going to be the risk-free rate of return. And then for both of these, what are the causes of the yield spread? And I would remember those boxes over on the right: taxation, liquidity, credit risk, and inflation. Inflation almost always is a component of something. And then that expected real rate. All right, so this is a great link between what we're doing in this reading and what we did back in the economics readings. Now, the yield spread over a specific benchmark is known as the benchmark spread. The spread over a government bond is known as a G spread. And the spread over the standard swap rate is the I spread. And this one is really cool. This one's going to be important, especially at level 2, this zero volatility spread. And so I want you to think about this. What this is going to do is this going to be a spread that makes the present value of those cash flows, when it's added to the yield at each point on the Treasury spot curve, to be equal. And the CFA program will show you how to compute that zero volatility spread in level 2. And that takes us through our fixed income valuation. Next, we'll talk about asset-backed securities.